If you woke up today, Saturday, February 7th, 2026, and felt a strange static in the financial air, you weren't imagining it. You likely checked your portfolio and saw silver up 3% and gold ticking steadily into the green during a low-volume weekend window. The mainstream talking heads on CNBC are already spinning the narrative. They're calling it a geopolitical hedge. They are whispering about Fed rumors or Middle Eastern tensions. They are lying to you. What you are witnessing at this exact moment is not a market move. It is a regulatory detonation. It is the first visible crack in a dam that has held back the true value of hard assets for over half a century. I am your host and you are watching Analysis with AG, and today we are going to look past the narrative and into the mathematics of a systemic failure. This is not speculation. This is not a conspiracy. This is a legal deadline that 99% of the financial world has chosen to ignore until it was too late. That deadline is Monday morning, February 9th, 2026, at the opening bell. In less than 36 hours, the Net Stable Funding Ratio, or NSFR, under the Basel III framework, finally moves from a negotiable guideline to a strict enforcement reality for every major European and American bullion bank. For over a decade, these institutions have lobbied, delayed, and watered down these rules. They assumed the day of reckoning would never come. They were wrong. The Bank for International Settlements, the central bank of central banks, has effectively pulled the plug. Compliance is no longer optional. Your license to operate as a financial institution now depends on your balance sheet aligning with physical reality by Monday morning. To understand why this is causing a panic in the boardrooms of JP Morgan, Goldman Sachs, and HSBC, you have to understand the crime scene of unallocated precious metals. Under the old rules, banks could treat paper claims on gold and silver futures contracts, ETFs, and unallocated accounts as low-risk assets. They could sell silver they didn't have to buyers who didn't want delivery, creating an infinite supply of synthetic silver that kept the price artificially suppressed. But as of Monday, the game is over. Unallocated precious metals have been reclassified as Tier 3 high-volatility illiquid assets. This means if a bank is holding $1 billion in paper shorts, they must now hold $850 million in Tier 1 cash reserves to back that position. The regulatory incentive has flipped 180 degrees in a single weekend. Physical metal is now the only zero-risk asset. Paper is now a liability that could bankrupt the holder. Do you see the trap? Every major bullion bank that has spent the last 15 years manipulating the price of silver through naked shorting is now staring at a balance sheet crisis. They are non-compliant. They are in violation of international law. And the penalties aren't just fines that can be paid off as the cost of doing business. We are talking about the revocation of banking licenses. We are talking about being permanently cut off from the Federal Reserve's discount window. We are talking about being barred from the European clearing system. These banks have only one exit strategy. They have to convert their paper to physical. They have to cover their shorts. They have to buy actual physical metal. And they have to do it before the sun rises on Monday. But here's where the mathematics turn into a nightmare for the establishment. Let's look at the Comex data from Friday night, February 6th. The total open interest in silver futures was 420,000 contracts. Each of those contracts represents 5,000 ounces of silver. That is a total of 2.06 billion ounces of paper silver claimed by the market. Now, compare that to the total global mine production for an entire year, which is roughly 850 million ounces. The paper market has sold 2.5 years of the entire planet's production in contracts that don't exist. But it gets worse. The actual physical silver sitting in Comex vaults that is registered and available for delivery is only 64 million ounces. Let that sink in. We have over 2 billion ounces of paper claims chasing 64 million ounces of real metal. That is a leverage ratio of 32 to 1. On Monday morning, the regulators are telling these banks they need to back that 32 to 1 leverage with 85% cash or physical metal. There is not enough silver on planet Earth to cover even 10% of those claims. This is not a short squeeze in the traditional sense. This is a systemic collapse of the fractional reserve bullion system. This is why the price spiked at 2047 p.m. on Friday. It wasn't retail investors. It was the first wave of algorithmic covering by European banks who realized they were trapped. I tracked the trade volume in the SLV ETF, and at exactly 2047 p.m., a block trade of 14 million shares hit the tape. That isn't a retail trader on an app. That is an institution in a state of absolute panic. Before we go any further into the mechanics of this collapse, I need you to do something right now. Smash the like button on this video. I am not asking for your engagement for the sake of my ego. I am asking because the algorithm is already trying to suppress this data. I can see the real-time analytics. This video is being throttled. The establishment does not want the public to understand the why behind the price explosion that is coming. They want you to think it's random volatility, so you'll sell your physical metal back to the banks at a discount. Do not let them win. Hit the like button, share this, and force this information onto the trending page. We need to beat the algorithm before the banks beat the market. Now let's talk about the Zhuang position these banks are in. In chess, this is a situation where every move leads to disaster. Option 1 for the banks, they liquidate their short positions by buying back futures. But because there is no sell-side liquidity, their own buying will drive the price to $50, $80, or $100 an ounce, bankrupting their trading desks. Option 2, they try to take physical delivery to make their accounts allocated and therefore Tier 1 compliant. But as we saw, the vaults are empty. There are 32 people standing in line for every single ounce of silver. If the first 2 people in line take delivery, the other 30 are left holding a worthless piece of paper. Option 3, they beg the Federal Reserve for a multi-billion-dollar bailout to meet their reserve requirements. But the Fed is already drowning in its own balance sheet crisis. The Treasury market is illiquid. The commercial real estate market is imploding. The Fed cannot save the bullion banks without hyperinflating the dollar into oblivion. This is the Great Divorce. For decades, the paper price and the physical price have been married by the illusion of liquidity. But that marriage is over. The paper price is a lie created by high-frequency trading algorithms and, quote, stuffing. This is a technique where banks flood the order books with fake sell orders to trick the market into thinking there is an oversupply, only to cancel those orders milliseconds before they execute. It's illegal, but the fines are pennies compared to the profits. However, the algorithm only works if you have unlimited synthetic supply. Once the NSFR rule forces you to back your positions with 85% cash, you can no longer afford to bluff. The algorithm is breaking. The suppression mechanism is failing. And for the first time since the year 2000, we are about to see the true, unmanipulated price of silver. Look at history. This has happened before, and the results are always the same. In 1933, the banking system was insolvent because they had issued more paper claims on gold than they had gold in their vaults. Roosevelt's solution was Executive Order 6102, confiscate the gold from the public at $20 an ounce, and then immediately revalue it to $35 to recapitalize the banks. It was a massive wealth transfer. Then again in 1971, when foreign governments realized the U.S. had printed too many dollars relative to its gold reserves, Nixon closed the gold window. He defaulted on the world. The price of gold went from $35 to $850 in less than a decade. Why? Because once the paper lie is exposed, the physical reality must be priced in. We are at that same inflection point right now with silver. While the Western banks were playing games with paper derivatives, the East was watching. China, Russia, and the BRICS nations have been front-running this regulatory shift for 6 years. In 2024 alone, China imported over 7,000 metric tons of silver. That is 25% of the entire world's mine production going into one country's strategic reserves. They aren't using it for jewelry. They are using it to build the foundation of a new asset-backed monetary system. They know that silver is the Achilles heel of the Western financial system. They know the West is short, and they are the ones holding the physical. When the Comex finally declares force majeure, which is a fancy legal term for we don't have your metal and we're not giving it to you, the East will be the new financial superpower. The West will be left holding paper, and the East will be holding the gold and silver. I want you to go to the comments section right now and tell me what you are seeing on the ground. I spent the last 24 hours calling bullion dealers across the country. Every single one of them told me the same thing. We are sold out of silver eagles. We are sold out of maple leafs. Our backlog is 6 weeks deep. And the premiums? They are exploding. The spot price on your screen might say $31, but try to find a physical ounce for less than $40. That $9 gap is the sound of the system breaking. It is the great divergence in real time. If you are seeing high premiums or empty shelves at your local shop, post it below. We need to document the physical shortage while the media continues to pretend everything is normal. Let's walk through the timeline for the next 72 hours. Sunday night, 6:00 p.m. Eastern. the futures market opens. This will be the most important trading session of your lifetime. If we see a gap up in price, it means the banks have given up on suppression and are scrambling for the exits. Monday morning, the London bullion market opens. This is the heart of the unallocated paper world. If the London banks cannot meet their NSFR requirements, we could see a complete halt in trading. By Tuesday or Wednesday, the physical shortages will be headline news. By then it will be too late to buy. The doors to the vault will be locked. You need to understand that the BIS is not doing this to be fair. They are doing this because they know the current debt-based system is terminal. They are trying to reset the banks by forcing them to hold hard assets before the dollar collapses under the weight of $35 trillion in debt. They are choosing winners and losers. The winners are the banks that bought gold in 2019 when it was reclassified as a Tier 1 asset. The losers are the retail investors and the commercial banks that stayed short and unallocated. If you own physical metal, do not sell. I don't care if the price hits $50 on Monday. That is just the paper market trying to find a bottom. The true value of silver, when measured against the trillions of dollars printed since 2020, is in the hundreds, if not thousands. We are moving from a world of price to a world of value. In a world of value, the person holding the physical metal makes the rules. The person holding the paper contract is just a creditor to a bankrupt institution. This is the truth teller moment. They will call this a black swan event. They will say nobody could have seen it coming. But you are seeing it now. You are looking at the mathematics of 2 billion ounces versus 64 million. You are looking at the 85% reserve requirement that starts in 36 hours. You are looking at the end of the greatest price suppression scheme in human history. Subscribe to this channel and turn on notifications immediately. I will be doing live updates as the Sunday night futures open. I will be tracking the force majeure filings. I will be watching the premiums. Do not depend on the mainstream news to tell you when to act. By the time they report it, the opportunity will be gone. The banks are not sleeping tonight. The regulators are not sleeping tonight, and you shouldn't be either. This is the moment the paper dies and the physical rises. This is analysis with AG. Stay vigilant, stay physical, and I will see you at the Sunday night open. The silence you hear right now is the sound of the fuse burning. For years, we have talked about the day of reckoning. We've looked at the charts, we've analyzed the debt cycles, and we've waited for the catalyst. Most people thought it would be a war or a virus or a stock market crash. But the most devastating collapses are always regulatory. They are the quiet changes in the fine print that suddenly make the entire way of doing business illegal. That is what Basel III is. It is the sudden enforcement of honesty in a system built on lies. Think about the sheer arrogance of the bullion banks. They believed they could sell the same ounce of silver to 32 different people, and that those 32 people would never show up at the same time to claim it. It's the ultimate Ponzi scheme, backed by the prestige of the global banking elite. But the BIS has realized that if the banks are allowed to keep playing this game, they will eventually take the entire global economy down with them. By forcing the 85% reserve requirement, the BIS is essentially performing a controlled demolition of the paper market to save the underlying banking structure. They are cutting off the gangrenous limb of derivatives to save the torso of the financial system. But for the average person, this controlled demolition will feel like an earthquake. If you have your wealth in a bank account, you are a creditor to that bank. If that bank is one of the institutions caught in the silver short squeeze trap, your deposits are at risk. This is why the move into physical assets is not just about profit. It is about insurance. It is about removing yourself from a counterparty chain that is about to snap. When the Comex fails to deliver, every contract holder will be offered a cash settlement. But what is that cash worth in a world where everyone is trying to get out of paper and into hard assets? The cash will be trash, and the silver will be priceless. We have to look at the quote stuffing and the HFT algorithms one more time, because this is the smoking gun of the crime. For 15 years, every time silver tried to break out, a massive sell order would appear out of nowhere, crushing the momentum. This created a psychological barrier for investors. It made silver look like a dead asset. It made people think that it would never go up, regardless of inflation or demand. This was intentional. It was psychological warfare designed to keep you in the dollar and out of the one asset the banks feared. But that algorithm requires liquidity. It requires the ability to move paper back and forth without consequence. On Monday, the consequence becomes an 85% capital charge. The sell button has just become incredibly expensive for the banks. They can't afford to suppress the price anymore. The lid is coming off the pressure cooker. I want you to visualize what happens on Monday morning at 9:30 a.m. The opening bell rings. A hedge fund manager looks at the silver price and sees it's already up 15% in the overnight session. He tries to buy a futures contract to hedge his position, but there are no sellers. The bullion banks, who usually provide the sell side, are busy trying to buy back their own shorts to meet the NSFR deadline. For the first time in history, there is a bid, but no ask. The price begins to gap upward. 35, 40, 45, 50. It doesn't move in cents anymore. It moves in dollars. This is what a liquidity vacuum looks like. This is what happens when the paper illusion vanishes and we are left with nothing but the physical reality. And what about the industrial demand? This is the part the banks really didn't account for. Silver is not just money. It is the most conductive metal on the periodic table. You cannot build a solar panel without it. You cannot build an electric vehicle without it. You cannot run a 5G network or a cruise missile without it. While the banks were shorting paper, the tech companies and the military-industrial complex were burning through the physical supply. We are currently in a structural deficit of 200 million ounces a year. That means we are using 200 million more ounces than we mine. The only thing that filled that gap was the registered inventory at the Comex, and now that inventory is being raided by the banks themselves to cover their regulatory requirements. The industrial users are going to realize that if they don't buy silver right now, their factories will stop. They will start panic buying alongside the banks. This is a perfect storm. You have regulatory pressure from Basel III, you have a 32-to-1 paper-to-physical imbalance, you have a structural industrial deficit, you have geopolitical accumulation by the BRICS nations, and you have a complete loss of faith in the dollar. All of these vectors are converging on Monday morning, February 9, 2026. This is the regulatory detonation I warned you about. I've been doing this for a long time. I've seen the silver squeezes of the past. I saw the 2011 run to $49. I saw the 2021 Reddit squeeze, but those were different. Those were driven by retail investors trying to fight the banks on the bank's own turf, the paper market. This is different. This is the regulators fighting the banks. This is the system turning on itself. This is the great divorce where the paper market is simply being discarded because it is too dangerous to maintain. If you are listening to this, you are the remnant. You are the small percentage of people who bothered to look at the data while everyone else was distracted by the latest celebrity scandal or political theater. You have a 36-hour head start on the rest of the world. Use it. I cannot tell you what to do with your money. I am not a financial advisor, but I can tell you what I am doing. I am checking my physical holdings. I am making sure I have zero exposure to unallocated accounts. I am preparing for a week where the financial headlines will be filled with words like contagion, force majeure, and systemic failure. The algorithm wants to bury this video because the truth is dangerous to the status quo. If everyone understood what was happening on Monday, there would be a run on every coin shop in the world by noon today. The banks need you to stay calm. They need you to believe that the weekend price action is just volatility. They need you to keep your money in the system just long enough for them to get their own money out. Don't be their liquidity. Don't be the bag holder for a 15-year-old manipulation scheme that is finally collapsing. I will be here. I will be watching the charts. I will be monitoring the BIS communications. I will be your eyes and ears as we move into this great reset. We are moving into a new era, an era of hard assets, of physical reality, and of mathematical truth. The age of the paper lie is ending. The age of silver is beginning. One last time, hit that like button. Leave a comment. Share this with one person you care about. We are in this together. The banks have the billions, they have the algorithms, and they have the medium. But we have the data, we have the truth, and we have the physical. On Monday morning, we find out which one is more powerful. This is John CC with Analysis with AG. The doors are locking. The vault is empty. The countdown has begun. I will see you on the other side of the opening bell. Stay strong, stay physical, and most importantly, stay informed. The truth is coming and it will not be silenced.